Dividend investing has been a thing as far as stock market investing is concerned. It has always been one of the ingredients for the recipe of passive income and financial freedom. To some extent, a lot of people actually have some misunderstanding towards dividend, thinking that dividend is actually free money or money falling from the sky. In this video, I'm going to share with you some cold, hard, and inconvenient truths about dividend-based investing from the perspective of a retail investor and why you should or should not consider investing solely for dividends. And this video, I'm going to split the content and discussion into 4 different parts. Now let's move on to the first part. Understand under what situation a company will or might give dividend. But before we cover this part, we need to talk a little bit about basic accounting. But trust me, it is going to be very basic because my level of accounting is pretty basic as well. So first thing, when a company makes some money from their sales and usual business activities, we call this revenue or sales. Let's just put sales right over here. And then the next thing that you're gonna deduct from your sales is actually what we call cost of goods sold, meaning that this is how much your products cost you as a business owner. And then what you get is actually what we call gross profit. Okay? And then after that, what you need to deduct is actually your kind of like all those expenses, your operating expenses, your administrative costs. Okay, so they call it SG&A, and also your operating expenses. This is basically the general expenses that you need to operate your entire business or company. And then what you have here is earnings before interest, tax, depreciation, and amortization. And after that, what you need to do is actually to deduct your depreciation, and then of course amortization, and what you're left with is actually earnings before interest and tax. And as you guess it, the next part is actually minus your interest and minus your tax, meaning that the company has to pay tax, and then you will get into one thing called earnings after tax. So here, the company would decide whether or not they want to give out dividend. So if they choose to give out dividend, okay, in this case, you should already know that the company is making money because they are paying their tax, and then you have an earnings after tax. So meaning that the company is making money. So right now, if they decide to give out dividend, they will minus the dividend right over here. And what they are left with is actually what we call retained earnings. This is what the company is left with. So from here, we can actually see that if the company decides to give dividends, they will have less retained earnings. In other words, if they do not give dividends, in this case, the entire earnings after tax would be their retained earnings. And understand that from a business perspective, retained earnings is the cheapest source of fund because you don't have to raise your equity and raise funds, or you don't have to borrow money, which is called debt, and you have to pay interest over the mid to long run. So retained earnings is actually the cheapest source of funds for the company if they need to do things like R&D, expansion, and things along those lines. After understanding basic accounting, right now we need to talk about one thing called business life cycle. So there are actually 4 stages of business life cycle, and in this axis we have your sales, and in this axis we have your time. And in a typical kind of life cycle of any business or any products, there are actually 4 stages. So let me just put this into 4 stages. First, 2, 3. Okay. The first stage is what we call introduction. And this is whereby a business is just being founded and then things are going a little bit slow and steady. Things are just getting started. So the next phase is what we call growth. Growth is when we see an exponential increment in sales volume and profits and whatnot. So this is what we call growth. And after a period of time, things started to top, okay, to stay at the top, and things starts to peak already, and then this is what we call maturity. So after maturity is what we call decline, whereby the business starts falling off. So again, we have the introductory, we have the growth, we have the maturity, mature, and then we have the decline. Now, understand one thing. Companies that are in the growth stage, okay, companies that are in the growth stage, okay, which is this stage right over here, requires a lot of expansion, requires a lot of R&D. So to them, they need funds. So the cheapest source of funds, as we have discussed just now, is actually retained earnings. So think about it. Growing company is not going to be so generous in giving out dividend. And a lot of time, many dividend-based investing, they are looking into companies that are generous in giving dividends. And those companies are actually in the maturity stage, because when a company is in a maturity stage, they do not need a lot of retained earnings for expansion, for R&D and things along those lines. So that's why they are very generous in giving out dividend to reward their shareholders. So my question to you is, do you want to invest in growing company, or do you want to invest in companies that are in their maturity stage? So think about it. Which type of companies would actually give you higher potential return? And also, second thing, would growing company, if you reckon that growing company is going to give you higher return at the most generic level, let me ask you, are growing companies going to be very generous in giving out dividends? I'm not sure about you, but if you were to ask me, I would prefer invest companies that are in the growth stage, because these companies are expanding their market share. They are increasing their market capitalizations every single day. And there's a risk of investing into company in the maturity stage. Although they are very generous, they can be very generous in giving dividend, there is one risk. If a company is in a maturity stage, there is a risk of the companies entering into a declining stage very soon. But of course, from the business standpoint, there is one thing that they can do, which is to extend their business life cycle by introducing more products, newer innovations, and things along those lines. And with this is what we call business life cycle or product life cycle extension. So when they're in a maturity stage, or when it starts to decline, they can actually do something to extend their product lines or business life cycle. And this is what we call business life cycle extension, this part over here. And think about it. If a company were to go into an business life cycle extension, do you think that they will still be so generous in paying dividends to their shareholder? So think about it. Now let's move on to part 2. Retail investors do not make actual money from dividend payout. And yes, you heard it correctly. So assuming that today this is your first jar, and you name it the first jar called SA, stands for your saving account. And right inside your saving account, you have $10. And you decide to invest this money. So you invest this money, okay, by putting your $10 into this trading account or investment account. So your $10 is no longer in your saving account, and right now your trading account or your investment account, so let's just put this as trading account or your broker account has a share that is worth $10. So right now, assuming that there is no share price movement, all right? There is no share price movement. Assuming that there is no share price movement, this company is giving $1 worth of dividend. So after investing for a period of time, this is maybe this is part 1 and this is part 2, because you have invested for a period of time, assuming there is no share price movement. They give $1 worth of dividend. Dividend equals to $1 per share. So on the X date, your trading account value will worth $9 because there is a price adjustment on the stock. And another $1 will be your dividend, and that dividend will be paid out to your saving account or any bank account that you point the broker to deposit your dividend. And then, for example, you point it to your saving account, and then your saving account would have $1, and that is actually your dividend. So actually, from this scenario, assuming that there is no capital gain or loss, you actually do not make any money from dividend payout. It is basically transferring your money from left pocket to right pocket. You're transferring a little bit of your investment value from your trading account back to your bank account or saving account. So throughout this entire process, I hope that it is clear enough to let you know that dividend payout itself, this event is not making you extra money. What actually makes you money is actually capital gain from your investment. When a company's stock price is declining, some investor will reassure themselves by telling themselves, oh, never mind, the company is still giving dividends, so drop in share price is okay. After understanding that you don't make actual money from dividend, let me just share with you, this is the worst lie you can tell to yourself. Now, things can be a little bit more interesting and also complicated at the same time if we bring tax into the picture. And that's exactly the part 3 of this discussion. Part 3, let's discuss about the tax implication on dividend income and capital gain. But before I proceed further, very quickly, a disclaimer, I'm not a tax advisor. So for your whatever taxation needs, please consult your tax advisor. Now, investors are subject to pay taxes on capital gain and dividend income depending on the country of tax residency. And this can be a very difficult and complicated topic because different countries have different tax treat, ranging from things like short-term capital gain and long-term capital gain to ordinary dividend and qualified dividends. For certain countries, there might be situations whereby investing for dividends might make some sense because the tax treat on the dividends is lower or more forgiving than capital gain. Under most cases, participating in dividend reinvestment plan or DRIP will avoid being taxed, and you will be using your entire dividend payout to repurchase the company's stock. Now, I come from Malaysia and I'm staying in Malaysia and I'm a tax resident of Malaysia. So it is a country whereby capital gain from stocks is non-taxable, at least for now, unless you are a full-time trader or your primary income is from stock trading. And also, dividend is non-taxable here in Malaysia, except for some cases like dividends from REITs, which is a real estate investment trust. If we were to invest in US stocks, there will be no capital gain tax as well. However, if the company were to give dividend, there is a 30% withholding tax, which means if a company gives $1 worth of dividend, then I will get 70 cents, whereby the 30 cents would be the tax. Now, of course, the workaround is actually participating in the DRIP program, which is dividend reinvestment plan. Regardless if I invest in my local stock market or the US stock market, from a mathematical standpoint, investing solely for dividend or dividend-based investing actually make no sense, at least from my very own perspective. Now, some people might argue that if the company pays dividend, I reinvest the dividend, I get more stocks, and next time when the company pays dividend, I get more dividend, yada yada yada. I know what a lot of people are trying to tell. I don't think that this is a good argument because there is actually a price adjustment. I can also argue that if the company does not give dividend, I would have more capital gain in the future, which is essentially the same thing, and the company would have more retained earnings for good. They can do a lot of expansion, they can do a lot of R&D and introduce new products. And don't forget, retained earning is the cheapest source of fund for any company. If you can fully comprehend what I have shared with you so far, I bet you wouldn't feel so good about dividend payout right now. Now, don't get me wrong. Dividend is not a bad thing because it at least tells us a little bit about the company, at least the fundamental side. We know that that company is making money, that's why they can afford to pay dividend. However, at the same time, it is not really an exciting thing like the majority investors would think about dividend. Now, in this section, I'll be sharing with you who is the real winner, because understand that from a retail investor's perspective, we don't actually make any actual gain from any dividend payout. So the question is, who is the real winner for every dividend payout? Imagine you and a few of your friends are the shareholders of a company. You guys invested a lot of money into the company. You guys vote for the right persons to manage the company. You guys vote for the CEO, COO, and so on. And those people are managing the company for you guys. After a few years, the company makes money and the overall enterprise value has gone up. Now let me ask you one question. What would be the most logical way for shareholders like you to be rewarded? Would you sell your stocks because the enterprise value of the company has gone up and then you want to make some profit by selling off your shares? Definitely no. I bet you wouldn't, because you still want to maintain your share in that company so that you still can vote for the right persons to manage and operate the companies so that the company can still grow. So the most logical way, and actually the best way in this case, is actually to pay out dividend to the shareholders. Of course, the caveat will be the company does not need that much retained earning for future operations. Of course, you can adjust the amount of dividend paid out as well in this case if you need the retained earnings for good. After paying shareholders with dividends, the entire enterprise value will reduce because the amount paid out in dividend no longer belongs to the company. But let me ask you one question. In this very specific scenario, do you even care about that? If we translate this thing into investing in the stock market, the real winners of every dividend payout is actually the same group of people. There are always a group of people who wants to maintain their voting rights in that company because they want to vote for the next CEO and the next management team, and they don't mind the capital reduction or market cap reduction. They just want to maintain the voting rights while having some reward from that company, and the way for them to be rewarded is actually via dividend payout. For normal retail investors, all these things would not matter because what we need is just profit from the stock market. And right now we already understand that as a retail investor, we do not actually make any gain from any dividend payout. So capital gain will still be the only portion of our actual return. Having said that, companies are still going to give out dividends because of two reasons primarily. The first one, there are still a lot of investors who are going to feel good for getting dividend. And because of this, it has been a very common tactics for companies to give dividend in order to boost or increase the confidence of their investors or shareholders. Now, second reason is, of course, do not forget who's the real winner. Now, to wrap up this video, I'll be sharing with you From my very personal opinion and perspective, what should be the right mindset for retail investors to look at dividends or dividend-based investing? First thing, dividend is not money falling from the sky. It is not free money. It is basically your own money. It is just transferring your money from the right pocket to the left pocket. But again, dividend is not a bad thing thinking from a fundamental perspective, because if a company can give dividend, it means that the company is profitable, they pay the tax, and then they can have extra money to give you some dividend as a reward. However, the debate will be if the company is giving out a lot of dividends or is very generous in giving out dividend, it could also mean that the company does not have a better way to utilize their retained earning for future development and so on. That's why they are giving out a lot of dividend, because logically thinking, if a company is growing rapidly, the company would need funds, and the cheapest source of fund would be retained earning. And if they need the fund when they see their earning after tax, the logical thing is they would not give so much dividend. They want more retained earning for their R&D, for any future development and things along those lines. The way I look at dividend payout is a small withdrawal of your portfolio value without selling your stocks. Because all other things being equal, if the company gives dividend right now, then you will have less capital gain in the future if you decide to sell your stock in the future. And also, if a company does not give dividend right now, you would have more capital gain in the future. And to me, it's actually better because it means that the company has more retained earnings for future development and things along those lines. So if you're the type of long-term investors who want to stay invested in the companies that you have conviction for, then this future withdrawal discussion or cashing out without selling stocks kind of concept may be a little bit less relevant to you if you plan to stay invested in those companies for the next 5 years or even the next decade or decades. This might be less relevant to you, but understand that throughout the entire process, you actually don't get any real return as well, because dividends are not free money. It is just like a cash flow for you in this case. The cash flow is actually also coming out from your future capital gain, but it might be less apparent if you are a long-term investor in this case. Dividend-based investing only makes sense if you are building a portfolio by investing into stocks that you plan to buy and hold and just accumulating along the way. In this case, you will see your dividend payout gets bigger and bigger, and eventually this passive income source will reach an amount that is more life-changing. Only if you are emotionally ready to adopt a buy and hold strategy and the money invested in those companies are for the super long term, you kind of treat the money invested in those companies are like hedging against the inflation and being less calculative on the capital gain side things and also the stocks price fluctuations. Or else, I would usually point people away from dividend-based investing because, like it or not, here's an inconvenient truth. Most people would still need actual return. And when I say actual return, I refer to capital gain. With that said, that will be all for this video. I hope that you get a little bit more understanding about dividend-based investing and also investing for dividend in the stock market as a retail investor. So if you find this video helpful or you learn something from this video, do not forget to hit the like button and also subscribe to this channel. Turn on the notification bell for more videos like this in the future. With that said, thank you very much, and I will see you when I see you. Peace out.